Your mortgage might be nearly paid off, the kids are independent, and your RSP has grown nicely over the years. But here's the catch. It's also the point where the wrong tax move can quietly destroy decades of smart savings, because the tax rules that apply in your 60s aren't the same as they were in your 40s and 50s. In fact, there are 4 specific tax traps that can dramatically increase how much the CRA takes. And most retirees don't even realize they've fallen into them until it's too late. Today, I'm going to walk you through each of those traps, what they are, how they sneak up on Canadians around age 60, and what you can do right now to avoid them. Hi, I'm Stefano Francesca, Senior Wealth Manager and Certified Financial Planner Professional at Next Step Wealth Management with IPC Securities Corporation. If you find this helpful, don't forget to like, comment, and subscribe. It really helps more Canadians see this and make smarter financial decisions. And before we get started, if you're approaching age 60 or already in your early 60s, this is the most important window for retirement tax planning you'll ever have. Click the link in the description to book a no-obligation consultation with me. We help our clients review their income sources, run detailed projections of RRSP, CPP, and OAS timing, and show them how to avoid OAS clawbacks, minimize RRIF shocks, implement the right investment portfolio to accomplish your goals, and build a sustainable income strategy before the CRA takes control. Because your 60s aren't just another decade. They're your retirement danger zone or sweet spot, where small planning moves can save you tens of thousands in future taxes. Tax trap number 1, the RRSP to RRIF conversion deadline. This is one of the biggest and most misunderstood traps that catches Canadians off guard. By the end of the year you turn 71, you must convert your RRSP into a RRIF or annuity and start mandatory withdrawals the following year. Now, at age 60, that might sound far off, but it's not, because the planning window between your 60s and early 70s is where the real tax strategy happens. If you wait until 72 to start drawing income, you could be forced to withdraw more than you need, pushing yourself into a higher tax bracket and triggering clawbacks on your old age security. Here's the smarter approach. Between age 60 and 70, consider gradually withdrawing as you can while your income is still moderate. This allows you to smooth out your tax bill over several years instead of facing a big jump later on. Even small withdrawals in your 60s can help you avoid the potentially larger tax hit that comes from RRIFs in your 70s once the government starts forcing you to pull money out. This is also the time to start thinking about pension income splitting if you're married or common law. It can help balance your taxable income and reduce your overall tax rate. Just the other week, I spoke with someone who booked a consultation from one of my videos. He's 66 years old and hadn't yet started taking RRIF income because his spouse was only 61. Oops, another trap. What he didn't realize is that the age of your younger spouse doesn't matter as it applies to income splitting. As long as the person receiving the RRIF income is 65, they can split the income to a younger spouse. He could have been splitting RRIF income with her last year and effectively getting tax-free income into her hands, as all she had is a small CPP benefit. That's a few $1,000s mistake. Thankfully, we straightened it out moving forward. As well, once you hit age 65, assuming you previously didn't have eligible pension income, RRIF withdrawals now qualify for the $2,000 pension income tax credit. Another tax trap. Be sure to take dollars from your RRIF, not out of your RRSP, to qualify for this benefit. And by the way, the pension income tax credit is age-based for RRIF withdrawals. So in the previous example, once she reaches 65 and splitting income, then they can each claim the $2,000 tax credit, saving them $6,000 in federal tax plus their provincial tax rate. Tax trap number 2, the OAS clawback zone. The old age security benefit is designed to provide extra support to retirees, but it's income tested. Once your net income exceeds roughly $93,500 per person in 2025, the CRA starts clawing back your OAS at a rate of 15 cents for every dollar above that threshold. That means if your income reaches around $150,000, your entire OAS benefit could be clawed back. Now, this isn't just about the wealthy. It affects anyone who's accumulated a large RSP, has significant taxable income, or retained earnings in a corporation. For example, imagine you're 62, your spouse is 60, and you both have healthy RSP accounts. If you wait to draw down until age 72, if managed properly, those balances will continue to grow. And when converted to RRIFs, the required minimum withdrawals could easily push your annual income well above that $90,000 line. The result? You could lose part of your OAS and pay more tax at the same time. The fix is proactive planning. That might include drawing down RSPs in your 60s to reduce future RRIF income, or strategically deferring OAS to age 70 for a larger benefit and more control over when your income starts. The goal is to keep your taxable income below those critical thresholds so you can keep more of your OAS, not hand it back to the CRA. Tax trap number 3, timing your CPP and OAS too early or too late. Another common mistake I see at 60 is claiming government benefits at the wrong time. Many Canadians start CPP and OAS as soon as they can, at 60 and 65 respectively, thinking it's the best or safe move. But what they don't realize is it can create long-term tax inefficiencies and reduce the flexibility of their income plan. We did a video on this topic and the trade-offs a little while ago. We'll post a link here. If you claim CPP at 60, your payments are permanently reduced by 36% from your age 65 benefit. If you delay until 70, they can increase by up to 42%, plus inflation adjustments. Now, that doesn't mean everyone should delay, but you should coordinate the timing with other sources of income. For example, if you're semi-retired at 60 with little income, taking CPP early might make sense because the payments are taxed at a lower rate. But if you're still earning significant income, taking CPP early could just stack more income on top of your highest tax years. The same goes for old age security. Deferring it to age 70 gives you a higher payment and more time to draw down your RSPs or corporate assets first. The key takeaway is this: CPP and OAS are part of your tax plan, not separate from it. When you start them, can affect not just your benefits, but how much tax you pay over your entire retirement. Tax trap number 4, ignoring the TFA's strategic role. Many retirees treat the TFSA as a secondary account, something they only use for short-term savings, a slush fund, or extra money. But that mindset can cost you thousands in taxes. Your TFSA is one of the most powerful tools for tax-efficient retirement income, especially after age 60. Withdrawals are completely tax-free, they don't affect your OAS eligibility, and you can recontribute the same amount in future years. Here's how the tax trap works. If you're overly focused on withdrawals from your RSPs and RRIFs first and leave your TFSA untouched, you might push your taxable income higher than necessary, prepay too much tax, and potentially lose some of your benefits or tax credits, such as the age credit. On a federal tax basis, in 2025, you begin to lose that non-refundable tax credit once your income exceeds $44,325, and it's completely lost once you reach $102,925. But if you integrate your TFSA strategically, for example, by withdrawing from it in higher tax years, you can smooth your income, reduce your OAS clawbacks, and lower your lifetime tax bill. Think of your TFSA as your flexibility fund. It gives you the control to adjust your income year by year, which is incredibly valuable once you're in retirement. Bonus, the corporate tax trap for business owners. For incorporated professionals or business owners, there's one more trap that often flies under the radar. Many people leave retained earnings or investments inside their corporation thinking they'll just deal with it later. But if you don't have a plan to extract that money tax efficient before or in retirement, you could be setting yourself up for a much higher tax bill. That's because passive investment income inside a corporation can trigger higher corporate tax rates and reduce your small business deduction. Those with incorporated businesses over 60 should be thinking about the most tax-efficient mix of dividend and salary to remove from the corporation, how to use corporately owned life insurance to shelter future growth or to transfer assets tax efficiently as part of an estate plan, and whether it makes sense to wind down or freeze the corporation before retirement begins. The earlier you plan, the more flexibility you'll have to transition that corporate wealth into personal, tax-efficient income later. At age 60, the financial planning game changes completely. You've spent decades accumulating wealth. Now it's about how you withdraw it efficiently. These tax traps, RSP conversion deadlines, OAS clawbacks, CPP OAS timing mistakes, and ignoring your TFSA all have one thing in common. They're easy to miss until they're irreversible. That's why your 60s are so important and what I call the planning sweet spot. It's the decade where smart tax planning can save you tens of thousands, or poor timing can quietly cost you just as much. If you're a Canadian retiree or within 10 to 15 years of retirement and want to avoid these traps, now is the time to build, review, or fine-tune your strategy. Click the link in the description to book a consultation. We work with our clients to plan, implement, and manage well-thought-out strategies that reduce tax, provide sustainable income, and create certainty for your retirement. Let's take the next step.